if I had to start from zero in 2026. No savings, no connections, no financial background. I would not try to get lucky in stocks. I would not chase viral crypto coins. And I would definitely not wait for the perfect time. Because the truth is brutal. The perfect time to start investing was yesterday. The second best time is right now. In the next 20 minutes, I'm going to show you the exact step-by-step system I would use to go from $0 to building real wealth in the stock market, without gambling, without stress, and without needing to be a financial expert. And by the end, you'll know exactly what to invest in, when to start, how much to put in, and how to avoid the mistakes that destroy most beginners. Let's get into it. Let's be honest. Most people don't fail at investing because it's complicated. They fail because they never start. Or they start the wrong way. They keep their money sitting in a savings account thinking they're being safe. But here's the problem. Every year, inflation quietly eats your money. That $1,000 you're saving today, in a few years, it won't buy the same groceries, the same rent, or even the same lifestyle. You've probably already noticed it. That $5 coffee is now $8. Rent is higher. Food is more expensive. Everything keeps creeping up. That's inflation. And here's the harsh truth. If your money isn't growing, it's actually shrinking. Now let's break it down simply. There are only 3 things you can do with money. 1. Spend it. 2. Save it. 3. Invest it. Spending equals instant enjoyment. 0 future growth. Saving equals safety, but losing value over time. Investing equals long-term wealth. Building. Now, here's where investing becomes powerful. When you invest, 2 things start working for you. 1. You own pieces of companies. When you buy stocks, you're not trading numbers. You're literally owning parts of real businesses. Apple sells iPhones. Microsoft powers global software. NVIDIA drives AI chips. If these companies grow, your money grows with them. 2. Compound growth kicks in. This is the real secret. Your money earns money. Then that money earns more money. It snowballs. And here's the part most beginners don't believe until they see it. Even small, consistent investing beats large, one-time guessing. Time matters more than timing. This is where most beginners completely mess up. They try to pick winning stocks. They see something trending and think, this is the one that will make me rich. But history says otherwise. Let's look at reality. Companies that once looked unstoppable. BlackBerry, Kodak, Nokia. At their peak, they looked like forever winners. But they collapsed. So the question is, if experts can't reliably pick winners, why would beginners be able to? That's why the smartest investors do something different. They don't pick winners. They buy the whole market. The strategy: index funds / ETFs. Instead of buying one company, you buy a basket of hundreds of companies at once. This is called an index fund, or ETF. For example, S&P 500 equals top 500 companies. In the US NASDAQ 100 equals top tech companies. When you invest here, you're instantly diversified. That means, if one company fails, it barely matters. If 10 companies struggle, still stable. If the market grows, you grow with it. Even Warren Buffett has repeatedly said, most people should just invest in low-cost index funds. Now let's simplify it even more. Think of it like this. Buying individual stocks equals trying to find gold in one mine. Index funds equals owning the entire goldfield. Much safer, much more stable. Example: ETFs you'd see in real life. S&P 500 ETF, like VOO/SPY/SPLG. Total market ETF, like VTI, tech-focused ETF like QQQ. Now let's talk about something most beginners ignore. Fees matter. Every ETF has something called an expense ratio. This is basically the cost of owning it. Good rule, keep it under 0.5%. Lower is better, because high fees slowly eat your returns over years. Now let's clear one of the biggest myths. You need a lot of money to start investing. False. You can start with $1. But the real question isn't, how little can I start with? It's, are you financially ready to invest? Here's the simple checklist. Step 1. Do not invest if you have high interest debt. If you have credit card debt at 20 to 30% interest, that is an emergency. Why? Because the market does not guarantee returns. But paying off debt is a guaranteed return. Example, credit card debt, 25% interest. Stock market average, approximately 7 to 10% long term. So paying debt equals instantly earning 25% return. Risk-free. That's unbeatable. Step 2. Do you have an emergency fund? You need 3 to 6 months of expenses saved. Why? Because life happens. Job loss, medical bills, car repairs, emergencies. Without this, people do the worst thing possible. They sell investments at the wrong time. How much should you invest? There's no magic number. But here's a simple rule. Invest what you won't need for 3 to 5 years. Even small amounts matter. $10 per week builds habit. $100 per month. Long-term growth. $500 per month. Serious wealth. Building consistency beats size. Now let's make this real. You don't need anything complicated. Just 3 things. 1. Open a brokerage account. Examples: Fidelity, Charles Schwab, Vanguard, Interactive Brokers. Fund your account. Link your Bank Arrow transfer money. 3. Buy an ETF. Search for something like VOOSPYVTI. Choose Buy, enter amount. Confirm. That's it. You just became an investor. No stress, no guessing, no complicated charts. Important decision. You'll see 2 main account types. Retirement accounts, Roth IRA, 401k. Tax advantages, long-term focused penalties if you withdraw early. Regular brokerage account, flexible. No withdrawal restrictions. Taxable gains. Beginners usually start with both, depending on goals. Now here's where most people lose money. They try to time the market. They buy when it feels good. They sell when it feels scary. That is the fastest way to lose money. Let's make this simple. The truth about the market: it doesn't go up smoothly. It crashes, recovers, spikes, drops again, but zoom out, and the trend is always up. Biggest mistake beginners make: panic selling. During crashes, people think, it's over, I should get out. But historically, every crash looked permanent until it wasn't. Example, 2008 crash, COVID crash, .com crash. All recovered, all went higher. The real wealth formula: time in the market greater than timing the market. If you miss just a few best days in the market, your returns get destroyed. That's why the strategy is simple. Invest consistently. Ignore short-term noise. Hold for years, not days. If I had to restart from $0 in 2026, I wouldn't try to be smart. I would be consistent. Because wealth isn't built by perfect decisions. It's built by starting early, staying consistent, and not quitting. During fear, you don't need to predict the market. You just need to participate in it. Because the biggest advantage in investing isn't intelligence, it's time.